It just pretty much confirms what I've been looking at in the Treasury curve. And for me, I always start there just because I think it's the most powerful economic indicator we have. And the curve uninverted, the 2s and 10s. And usually when you see an inversion or an uninversion, it doesn't just like happen right at once. I always use the example of like a kid sticking his toe in the pool. And he knows the water's kind of cold, but he really wants to get in the pool. So the first thing he does is kind of dip his toe in there, and he retracts. Oh my gosh, that's cold, that's cold. But then his desire to get in that pool just increases to the point where he's like, well, I'm going to go ahead and put my foot in there. And then he puts, it goes up to his waist. And then finally he goes and dives in. That's usually how the curve inverts and uninverts. And the reason I pay so much attention to it is the hard landing or recession or whatever you want to call it. It typically happens after the curve is no longer inverted. So you have an inversion that has preceded every single recession we've had going back to the 1950s. Now we have had an inversion where it didn't result in a recession, but it's extremely, extremely rare. And so what you have to do is you have to not only look at the curve, but you've got to look at all the other economic data that we see. You have to look at the unemployment rate. You have to look at the SOM rule. You have to look at what corporate America is saying. You have to look at what's happening to the consumer. You have to look at what Disney is saying, what McDonald's is saying, what Airbnb. And then you have to put all these things together and try to come to a conclusion as to what the probabilities are that we will have a recession, hard landing, soft landing, no landing. And going back to the cyclicality of the curve, usually you see the curve uninvert, then the stuff hit the fan. And usually it uninverts initially kind of on its own, but then you get a real steep uninversion or a steepening of the curve due to a bull steepener as a result of the Fed dropping rates. And most people think that the Fed dropping rates is just going to bail everyone out, but they need to be very careful what they wish for, because the Fed has never dropped rates and prevented a recession. They've only dropped rates in response to a recession. And I just saw an article, for those people who are in the stock market, I just saw an article that was really good on Market Watch. And it was a chart that showed, it went back to, I believe, 1984, maybe the mid 1970s. I just scanned it briefly. And it was talking about how the Fed rate cuts only help the market if we're not headed for a recession. And so I don't know why they didn't just look at the curve, but another way to say that is you could just say the only time Fed rate cuts result in stocks going up is when the curve isn't inverted. And when it is inverted, you get the opposite. After the Fed cuts the first time, usually the stocks, I think they were using the S&P 500 as a proxy. Okay. They usually go down by, call it 15, 20%, usually see a close to, if not a bear market, after the Fed drops for the very first time. And then you also usually see interest rates at the long end of the curve go down further than they already have in the process of inverting to begin with. If something has happened 90% of the time since 1950, I'm going to go ahead and put my money on it's likely going to play out the exact same time. I think especially when you're looking at the Treasury curve, to say this time it's different is even more dangerous than that saying typically is. So that's kind of what I'm focused on right now. And what we saw happen in Japan, or what we've seen with Norinchukin Bank in Japan, that was about a month ago, what we're seeing with the unwind of the carry trade. I think a lot of people in the mainstream media like to peg this downturn that we've seen in the market or the volatility increasing specifically on the yen carry trade. But if you go back to the soft CPI report that we had about 3 weeks ago, I think that's really when it started. And when I mean it, I'm talking about the narrative change that you usually see in these type of cycles when bad news goes from being good news because, oh my gosh, the Fed's going to cut rates, so that's great, to holy cow, bad news is actually bad news. And going back to that soft CPI, the NASDAQ tanked, and you would expect the NASDAQ to do the opposite. So that was where I first kind of got the spidey senses and said, wait a minute, maybe we're at that point in the cycle when you do see that narrative shift. And then Powell came out and he gave a very dovish press conference. And again, you would expect the NASDAQ especially to rip higher on that. And once it started to digest the information, it goes straight down, goes down on Thursday, goes down on Friday, and then you get the big brouhaha with the yen carry trade. So I think it was more about the market realizing that, okay, we've been too myopic here and focusing on rate cuts good. We need to zoom out. And when we do, we understand that all this soft economic data that we're receiving is likely bringing us to the point where the Fed's going to drop, not because they want to, but because they actually have to. And if we look at history, that's usually negative for risk assets. In fact, a lot of expert economists out there on Bloomberg or FinTwit, I see them making this mistake. And a lot of them even come to a crazy conclusion that the yield curve itself actually produces a recession. Like, okay. I guess maybe they're thinking because of, the flat curve is really bad for banks or something like that. I think it's the reason it's so powerful is because insiders have information that we just don't have. And it's not just illegal insider information. It's just if you're Jamie Dimon or you're a big bank, all your customers are these huge corporations and multinational corporations, and they have all this boots on the ground intel that you don't have. And CNBC doesn't have it, we don't have it, and they can see these things way in advance. So when they start to see all like the demand for loans going down, when they start to see their customers at dinner with these multinational corporations, the CEOs, when they're out to dinner with Jamie Dimon and they say, you know what, things aren't looking good. We're really gung-ho. We thought the Fed was going to drop rates. We thought we were going to have this soft landing, but it turns out what we're seeing, is the consumers really pulling back and the consumers tapped out. And most of that rebound, let's say from 2020 to 2024 was a result of artificial things that the government did during the COVID period. And now we're having to pay the economic fiddler, if you will. The rubber has to meet the road at some time. And so I think what happens is the Warren Buffett types, the Stan Druckenmillers, the Jamie Dimons, and Paul Tudor Jones, guys like that really have connections with not just business leaders, but also banking CEOs and banking insiders, and domestically and internationally. They see that we're starting to trend toward risk. And therefore, once they see that risk increasing, they're going to go ahead and they're going to buy treasuries. They're going to buy the long end of the curve. And that's what a lot of these global banks will do with their balance sheet capacity. So it's the banks also, these financial institutions and the insiders looking at their balance sheet capacity and saying, okay, do we want to lend into the real economy, whether that's in the United States or the global economy, Japan, pick your place. Do we want to lend and take that risk, or do we want to just take that balance sheet capacity and buy the long end of the curve because we see storm clouds brewing and we want to be in the kind of quote unquote risk-free, the most liquid, the safest type of asset we can be in, even if we're getting a slightly lower return. It's all about risk and reward. So when you see the curve invert, it's usually a result of two things. Number one, all of these financial institutions and insiders that have information we don't, buying the long end of the curve because they see the economic storm clouds brewing. And then while at the same time, the Fed is usually increasing interest rates at the front end of the curve, which is why you get that inversion, with short-term interest rates being higher than long-term interest rates. And then that adds insult to injury. That just pours gas on the fire. And then you usually get the Fed behind the curve once again. And then when they drop the rates, like I said earlier, it's in response to a recession. It's never to actually prevent a recession, especially when the curve is inverted to this degree. COVID is always an example I use because the curve inverted in August of 2019. So a lot of people think that was just a fluke. I personally don't. I have no way to prove this. This is all just kind of me trying to connect the dots. But again, if you're Paul Tudor Jones and you get a call from a banker in China that and he says, hey, you really need to pay attention to this Wuhan thing. And this, goes back to August. And you say, George, why do you peg August? Well, if you now read the reports, they say that if we did have this lab leak or whatever it was, they take it back to the summer of 2019. So what's going to happen? Well, that guy at the Wuhan lab is going to call his local politician. The local politician is going to call the local banker. The local banker is going to go up the food chain and call the politicians that call the banks in the Eurodollar system. And they're going to get on the phone with Jamie Dimon. Jamie Dimon is going to send a research assistant out to Wuhan to get the boots on the ground intel himself from the scientist who probably spilled the vial or whatever it was, right? And then that research analyst gets on the phone with Paul Tudor Jones and says, dude, this is legit. Like, this might not lead to a global pandemic, but we're at probably a 10% probability right now. Right. And so then Paul Tudor Jones thinks about that, and he's like, well, okay, even if this is a 10% probability, I need to hedge my bets, and I need to be in treasuries immediately. And that's why you could have seen the curve invert along with the other things that we talked about. But that's just an example of something that could have happened where it's not illegal, but these guys just flat out have information, and they're running billions, collectively trillions of dollars. And if they see a problem like that, if they see big risk, they're going to go into the most liquid and the safest asset. And whether we like it or not, that's treasuries. It's the this time it's different argument, which we see every single time in the cycle. But one thing that they really highlight, or the rebuttal to what I've just said, is, well, George, you can't look at unemployment because immigration is skewing the number. And if it wasn't for immigration, then unemployment wouldn't have spiked and we wouldn't have triggered the SOM rule. The other argument that you get with the curve is, well, if the Treasury was issuing debt at the long end of the curve, then the curve would be nice and steep. We would not have had an inversion to begin with. Those are the two arguments that you always hear. And therefore, we have to completely invalidate all of these metrics that have been so spot on in the past. Well, we'll start with unemployment rate. And this is just simply the household survey. And they take the household survey and they compare that with labor force participation. And I don't know the exact formula they use, but that's how they get the headline U3 unemployment data. And what's interesting, it's a survey of 60,000 participants. And then what they have to do is they have to take whatever the responses are and they have to plug that into an overall population number. But the overall population number that they've been using, or that they still use, is census data from 2022. Then they're going to change that up, but they changed that up in January of 2025, and then they just moved to 2023 census data. So if you want to argue, it's actually the opposite argument, that if you did include immigration, the immigration we've had since 2022, the unemployment rate would be much higher than it is because we're not including it. To look at the SOM rule this time and look at it back in the GFC or 90s or whenever, it is definitely an apples to apples comparison. That's just, anyone who says that really hasn't done the homework. And then let's look at the yield curve. So what the claim there is that Janet Yellen isn't issuing anything at the long end, and therefore supply is so tight, ironically, with deficits exploding and the debt being at 35 trillion. It's kind of a weird argument, right? That's what's bringing down those rates. But this, to me, is kind of a similar argument, because if you look at the actual amount of debt outstanding at each point in the curve, it's much higher today than it was in like 2019. Much higher. So sure, the percentage might be slightly different on the edges, but it's really not impacting. If you think about why people buy the curve, or why people buy treasuries, or what the treasury market really tells you, what interest rates tell you, there is really about future growth and inflation expectations. And it doesn't have much to do with supply. And although that's weird, I know it's counterintuitive to say that, but if you just look at history, that's kind of the way it plays out, that rates at the long end usually are thousands of variables, of course, but the main contributing factor is just what future growth and inflation expectations are, because you're always going to get paid back your principal plus interest. So that's one reason. But going back to this, also, I read a study the other day from a group of economists. I know Nouriel Roubini, he was in there, and they were talking about this exact same concept. They are looking at it through the lens of there being stimulus for the economy that we otherwise wouldn't have, and that stimulus is being controlled by Janet Yellen, because by not issuing at the long end of the curve, or issuing a lot less, then she has brought down interest rates and therefore mortgage rates, et cetera, and that just trickles through the whole economy. But even with their study, obviously they took the math on what the percentages usually are, and then they calculated the actual deficit, so the new issuance, and said, okay, well, if we had the normal percentages, this is how many 10-year treasury bonds or notes or whatever they're called, this is how many 10 years we would have. And they came to the conclusion that if they normalized everything, 10-year treasury yield would be a whopping 25 basis points higher than it is today.